Thank you. So to kick things off, I'll just set a little bit of the scene, and then I'm going to ask the panel members to introduce themselves. They say a week in politics is a long time. Well, I think in private credit at the moment, you could say a day is. There's almost something happening every day in this space. So we want to talk a little bit about what's going on in 2025 compared to last year. Secondarily, we've recently had our first cash rate reduction since some very big changes in the middle of 2022. And thirdly, if you're a keen observer of the financial newspapers, yesterday's Fin Review says ASIC zooms in on private capital funds. So let's just touch a little bit about what that actually means. So first of all, just immediately to my left, would you like to introduce yourself and where you're from? Thank you.
Sure, thanks a lot, Chris. Yossi Kraemer from Altor Brothers. We're a Melbourne-based alternative investment manager. We've got just shy of $5 billion under management, 5 offices around the world: Melbourne, Sydney, Brisbane, Singapore and Japan. We've got multiple products. We're direct real estate and property. We've got credit, both corporate credit and real estate credit. And we've also got an equities business which looks at technology investing and a listed small caps fund.
Great, thank you.
My name is Brehm. I'm the CEO of FC Capital. We're a Sydney-based credit manager. We got just shy of $1 billion of assets under management, mainly focused on corporate credit, asset-backed opportunities, and private securitization vehicles. We do not do property. Probably have done property once in the last 2 years. Our main focus is the Australian New Zealand market. Our capital is mainly offshore, and we just launched our first Australian vehicle, essentially.
Hi everyone, my name is Nicole Kidd. I'm from Schroders RF. We are a mid-market commercial real estate debt lender. And Schroders RF is a joint venture between Schroders, the large global British asset manager, about a 1.4 trillion Aussie equivalent AUM, and the Roberts family, which has its DNA in real estate. So former family who established Multiplex, and the former CEO of Multiplex's family office.
Hi, my name's Harley Dalton. I'm the General Manager of Altor Capital. Altor is a boutique alternate asset management business based out of Brisbane. Have 10 staff on the team. I've got a corporate credit fund with no exposure to property. We're going to talk a little bit about that, Chris, in a moment, about how we're all different across the table here, and look forward to sharing some insights around the credit markets.
All right, thank you very much all. Yossi, we might just kick off with you first of all. You've got a wealth of experience across this space. Can you maybe just unpack a little bit about why was last year such a boom year, and is 2025 going to be the same, or are we going to have a different trajectory?
Yeah, it's really interesting. There's been a lot of press about how much private capital has actually grown, and private credit's really grown over the past year. But really, if you actually look back, it's actually grown even more previous years. So last year was a bit more of a consolidation year. The current market, if you want to look at private credit, is probably about 205 billion or 180 billion, depending which report you want to read. And it's really experiencing about 7% to 9% growth per annum. But when we put that in perspective, and what we've seen globally, where you've got about $1.7 trillion US, as far as the kind of growth which you're seeing in other markets, globally, I think Australia's got a long way to go, and this is really just the start of that whole shift to private credit. I think the other thing is that which is really driving it, is we've got to look at both supply and demand. It's why is it occurring, and what's the demand side. On the supply side, there's lots of opportunity in private credit, and that's driven by APRA and driven by the banks' reluctance to provide credit to keep the economy driving, and that's really an important element. And on the demand side, we're seeing lots of both institutional and private wealth investors looking at this as an alternative asset class, as really as an alternative to fixed income and a way for them to grow. So by having both the supply and demand, we believe we're going to continue to see that growth.
So are the banks the best competitors you could wish for?
Absolutely, and we want them to continue to swim in the lanes that they want to swim in.
Very good. Harley, there's some big numbers in all this. We talk about the billions. If we just then look down at your business and your niche, as an asset manager, your role is really to, as I like to say, sort of, you're one golf club in the bag, right? You do that shot really well. So what do you do really well in your space?
Thanks for that question. Just to Yossi's point there too, in Australia we think about credit as this new asset class, but in the US this is a very normal conversation and it's a very normal part of most people's portfolio. So it does appear that it's very on point in the last couple of years. But I think if you fast forward 5 or 6 or 10 years, we'll look back and most portfolios in Australia will have a credit position. In Altor, I'm at the coalface, so we run an active management in providing sort of a $5 to $15 million solutions into growing businesses in Australia. And by active, I mean we will get inside those businesses to create value. I will pay back out to my investors a 10% distribution, and then I'll be looking to actually add extra alpha to that return in the form of taking an equity position or a warrant position or some sort of exposure where I say, I'm going to come in as a private equity player, I'm going to actually add value to your business, but I want to get rewarded for that, and that goes back into our unit trust to the benefit of shareholders. So, what is private credit? We have stepped into a space probably across the table here where the Australian banks have pulled out. And if I won't ask people to raise hands, but if you were a business owner in this room and you went to go and ask the bank for a credit position, it's very bloody difficult in this country now. The banks are not open for business, and this is a solution that has to come in and provide growth capital for these businesses.
So really for your clients, this is an alternative to the traditional bank model, effectively.
100%. The banks aren't open for business and they need a solution, and we want to come in and help those businesses grow. And we'll actively do that. So by active, I'm saying we will sit on boards, we will take observer rights. I don't want any surprises in my portfolio. I want to be ahead of any problems, and I want to be able to help those businesses.
Great. Christian, you can give us a bit of an international flavour.
Yeah.
Some comments already about sort of the private credit market in Australia is still relatively nascent.
Mm-hmm.
What does that mean for the growth we're still going to see as we're playing, in some ways, globally playing catch-up? Yeah. Are we going to see more products here in 25 that we haven't seen in 24 simply because we're just going through this growth journey? How do you see Australia comparing to the rest of the world?
I think there are two parts to it in Australia. One is the property side, and one is then the corporate credit side. And I think on the real estate side, and it goes to construction lending, goes to permanent real estate lending, we are fairly advanced in terms of what we do here and the players we have. We have players which are taking $200 million tickets, $40 million tickets, all the way down to two. So we have a very well diversified universe, and investors can access that. Where we have probably an underdeveloped market is on the corporate side, and that's basically which is growing at the moment. And the players in that space are, I would say, compared to the US and in Europe, there are not many of size where you can invest into, because you need to have a team there, like a very well-established team, a pipeline, you need to risk assess. So if you compare this to the US and in Europe and you speak to investors who are fairly active, let's say a Japanese pension fund, right? Then they go like, well, I got in the US like 30, 40 players which are north of 60 billion. I can pick. What's happening in Australia? That doesn't exist here. That doesn't mean that our market is not well developed, but our market at the moment holds an opportunity to develop that, to invest into it. But also what we as Australian fund managers need to do is develop the market, because we need to explain what private credit is. So I would say there is a bit of an arbitrage, a bit of a premium you can probably charge at the moment, which will probably go away over the next couple of years. But if you compare the Australian lending segment and you combine real estate and corporate, we are so far behind Europe and the US. I'm not sure what data we can use. I would say it's 15 to 25% of the lending here is done on the private side. In the US, it's probably 90. In Europe, it's 65. Here, we may end up in a European situation at 65 because our banks are fairly strong. So I think there's a good opportunity here to focus on both segments and focus a portfolio which is balanced or focuses on corporate and real estate at the same time.
Yeah. So 10, 15 years ago, when you were explaining to people about investing in private credit for property, you were really having to go through a whole chapter and verse on what that actually meant. And now what you're saying is that's almost sort of baked in. but we're now perhaps talking about the next evolution, just briefly, next evolution of the products under that private credit banner.
It is sort of baked in. I think the products will be products which are fairly well structured, simple structured, where we see an educational pieces on the borrower side. Yep. Not so much on the real estate side, more on the corporate side.
Yep.
Often people don't know private credit exists.
Yes.
And then you have to sort of give them a bit of a background in terms of how do you transact, what is your expectation, who are you, and the question
so
we get.
So to a certain extent, you're still going to have to educate the market. That's
100%.
That's the short answer. Yeah, great. Nicole, I just referred at the beginning about we're on ASIC's radar. We've talked a lot about the growth and the acceleration of the product. Are there some breaks here? Are we going to see more scrutiny in this space? Do you think ASIC's lens on this is justified, given the size of this space compared to the rest of sort of public markets? And what do you think is likely to come down the pipes? And I won't hold you to your crystal ball gazing.
No, I mean, it's a really, really good question, and not the one that's on our list, by the way, Chris. That's all right.
Well, keeping it interesting.
Yeah, that's okay. So, look, there's been a lot of chatter in the press about private credit, particularly about the opacity of private credit. But as investors are looking for new and interesting things to diversify their portfolios, for all of the reasons that my co-panellists have spoken about, private credit really does offer an interesting, thought bubble for investors to consider. Returns are attractive. There is more risk, understanding what that risk is, but also it's a very broad church, right? What we all do sitting on this panel, some parts of it may be similar, some parts of it could be vastly different. So if you are becoming a more active investor, and we've got lots and lots of wholesale and self-managed superannuation fund investors in this country looking for ways to take more control over their investment decisions, private credit does offer that because, as Harley mentioned, the banks have really changed the way that they do business in this country, and private credit funds have stepped in to assist corporate Australia and to assist the real estate developers and borrowers in this country to keep getting stuff done. So I welcome the opportunity to talk more about the space and to sort of dispel some of the myths that you see. There's a lot of chatter from competitor funds that aren't focused on this space about why it's bad, but I welcome the scrutiny. I think talking about the data behind what it is we do, none of us are sitting here saying we're not willing to talk about what it is we invest in, and I think the focus from the regulator is broadly welcomed by the private credit market.
If you're already doing the right thing, regulation 100%. Is actually a tailwind, right? It's a good thing.
Yeah.
So I think probably all of us actually welcome a call for transparency so that investors are very clear about what they're getting and what the underlying assets are. If you think back to the GFC, one of the things that happened afterwards is they interviewed people and said, "Did you understand what you're investing in?" And it became very clear that people had no idea, particularly the government in Iceland, apparently. But
if you read the report,
so that's one of the challenges. If you're investing, you want to know that you can actually have some look through, right? I think that's important.
For those of you that have needed some bedtime reading last night and you decided to read through the 66 pages of ASIC's review, which is available publicly, they're talking about the fact that the private credit space is not systemically significant at this point in time. All of the, the regulatory environment is set up to be successful for private credit. I don't know, Yossi, if you have a view.
Yossi, did you want to just add something?
Yeah, I'd actually go a step further than that. The reason why private credit began existing in Australia and exists today is because that's where the banks are not playing. And it's not because the banks don't want to lend there, it's because the regulator has got stricter capital constraints because the banks are so significantly important for our economy, the 5 banks that we really have. And so what we're lending to is we're not actually even creating super innovative products. I'm not trying to say that we're being special out there. We're actually doing what the banks had been doing previously, and we're just getting paid a lot more than what the banks were even charging previously. So we're not reinventing the wheel here. And so therefore, when you have commentators come from the US and talk about the risks which are involved, the US is a very different market. There's a lot more leverage in it. There's a lot more risks. A lot of the funds there are very heavily levered. Ours are very basic products and very simple. They're effectively bank-like products which are offered by non-bank lenders.
Yossi, you touched on risk there, and I think I'm just going to open it up. I'll kick off with you, Christian. As a leader in this business, when you look at risk for your business, what are the things that keep you awake at night? Is it deal flow, access to capital, regulation, economic conditions, the planning environment, market? Which are the ones that you think are prevailing in this year ahead, and for investors in this space, what are the ones that you think they need to be most thoughtful of?
For us at FC, I think deal flow is fine. Our pipeline has doubled since the last 12 months. What really keeps us awake is human resources, finding the right people, retaining the right people, finding good juniors, training them up, essentially in our business, and then transacting and risk management in the sense that how do I construct my portfolio? What are the industries I want to tap into? What are the industries I don't want to play into? So that's for us the biggest day-to-day conversation. Is this a business I want to take a position in? I want to fund, even with senior secured. Is this a business which will survive? And is this a business which can grow? We have seen turnaround opportunities where the business and the industry itself is a dying industry. Nothing has changed. The balance sheet was cleaned up. Yes, they're profitable. Do I want to lend to them? Probably not. I'll probably get more headaches. So it's more portfolio composition, the human resource element. I think from us, capital-wise, and what we see at the moment, there's a lot of demand for Australian credit. There's an immense demand from international investors at the moment, to a point where some people deploy in Australia probably with less of a risk management approach at the moment from the international scale, not Australian players. So that's our main focus on and the main risk elements we are seeing for our business at the moment in our market.
Yeah. So really plenty of opportunity, but it's about how much constraint there is in your business to be able to execute this from a Labor point of view. Please write to your local MP when you're discussing immigration. Harley, what about you? You're in a slightly different space in terms of looking at businesses to invest in, and therefore there's some much wider economic factors that come into play. How are you seeing the current climate?
In our industry and our my business, it's coming down to credit risk and your assessment of credit risk. So what keeps me awake at night is an economic shock, which you obviously can't predict. But we haven't seen a recession in this country for 25 years, and so understanding.
Is that because the government just keeps employing more public servants?
Yes, we just keep on pumping a little bit, having that safety net there, and that safety net just keeps going and going. But eventually that will stop. So credit risk, and then how do you mitigate against credit risk? And for us, that's around backing good quality businesses with tailwinds, and a lot of it, as we would all know in this room, you're backing. At the end of the day, you're backing people. And you're backing people to execute on a plan, and we just want to make sure that we are across that business and don't get any shocks, which is why I want to be sleeves rolled up in the business, not waiting for someone to come in and go, I've got a problem. We want to find out if there's a problem before we get to that problem. So.
And at any point in time, when you look at the sort of the number of transactions you're reviewing and the ones that actually drop out the bottom, sometimes your funnel sort of looks like that, and sometimes your funnel looks like that. What does your funnel look like at the moment, Harley, in terms of opportunities and conversion?
It's probably a little bit narrow at the moment. We have got opportunities, and one of the growth areas, I'm not sure if anyone heard Pete Sellerman talk before, but in this country there is this, that everyone's talking about intergenerational wealth transfer. It is real. 2 out of the last 3 deals we did were management buyouts. And that is people who can't find the other side of the transaction, and it ends up being internal. So the funnel is big in that area. We don't suffer from a lack of deal flow. It's actually how fast we can tick something through, and you want speed in crossing businesses out.
Okay.
Thank you.
Nicole, what's your read on the risk environment for the next 12 months for the type of offering you have?
Well, I mean, the biggest challenge that we have in our portfolio at the moment is, getting the deals to fall through the bottom. And they're not falling through the bottom because we're not competitive or not winning them. They're not falling through the bottom as quickly as we'd like because of a lot of sort of risks around approvals of development applications and issues with process and planning in various different states. And there's no homogenous planning system within each state in Australia. So we find a lot of borrowers are almost paralysed by delays or additional things that need to happen post the bushfires. You now need the RFS to sign off on your planning, and they're not incentivised to push things through so quickly. So we have a great housing shortage in this country. We have no shortage of borrowers wanting money to get their developments off the ground. We have a real issue with planning approvals that is paralysing some parts of our market in getting developments and product out.
And would you say that's on both the way in and the way out, i.e. to get the thing going, but also at the end?
No, mostly on the way in, yeah.
Mostly on the way in, yeah. Okay, yeah. I mean, one thing we've observed is that once you get to practical completion, if you're doing something in the property space, to go through the paper chase of getting the thing actually repaid at the end of the day. Yossi, I don't know whether you've got any comments on this, but you're almost out of the build, but you're into the paper chase.
Yeah, and
what happens?
Yeah, and you've got risks as well with the construction side. Is can you get the power connected? And that can take. You've got in your model, you've got that for 1 month, and it ends up being 3 or 6 months to get all of those trades in and to get your money back. And when we look, and that's really the key, is the first risk that we look at any transaction is we consider this like fixed income. We've got a very low tolerance for risk, so we've got a very narrow area which we like to lend in both on the corporate and on the real estate side. And that's because, we look at the risk and we say, we just want to get our money back. We're looking at this like fixed
Plus
income
your interest, Yossi.
Sorry?
Plus your interest.
Plus the interest, yeah, of course, but we want to get our money back is what we want to get. And that's the key risk. And what are the risks around that? And that's where we work from backwards then, is saying, okay, what could prevent us from getting our money back? Is it delays, and what kind of delays is that? Is it the people? Are the people really motivated on the corporate side to get those businesses working, to get the turnovers required that they have for those businesses? For the construction side, is that the right motivation? Have they got the right partners there? Have they got the right pre-sales? It's really looking at all of those risks to make sure that we can get to that final point where we're repaid and where we've made our money and we can return our money to investors. And that's the way we look at it. And I think that what we're seeing a lot out there is that there's an abundance of transactions, and therefore we can really be picky in this market. And I'm sure you're seeing that as well, Chris. I've never seen so many deals on the real estate side and on the corporate side in 30 years that I've been doing this now. Haven't seen that many deals that we can actually go start sifting through, and we can be really selective on who we want to lend to.
Yeah. So there is a lot of sifting through at the moment to get to the gems. Nicole, just for your business under that wider Schroders umbrella, if you look at investment classes, ultimately there's really only 5, right? You've either got cash, equities, property, fixed income / interest bearing, and alternates. We might put crypto or gold or whatever in there. How has your business effectively been plugged into that wider platform?
Private assets is one of the fastest growing investment areas globally, and Schroders, being a very global business, sort of 38 countries we operate in, are very interested in building a private assets platform. Real estate is a part of the market, whether it's equity or debt. People understand real estate. Like if I said the words the Great Australian Dream, like everybody in this room would know what that means, right? We all have the dream of owning our own home. Like people understand real estate. They have either had a home loan, aspire to have a home loan, or know someone that's had one. And so from a real estate perspective, we find that it is a part of the alternatives market that people can easily understand. And so when we talk about the education, in the spectrum of education of what is an alternatives investment, it is one of the more easily understood parts of alternatives investment. We also have security, I think, and that gives people a lot of comfort. So we find in our business in Schroders RF, we have a lot of retail investors. Those retail investors are in their income generation portion of their life, so they're looking at our product as an alternative to traditional fixed income. A way, not replacing it, we recommend it as a satellite allocation, but it is a way to diversify your portfolio, to become more active in it. And also from a Schroders perspective, they see this as sort of an increased way to think about democratisation of private assets.
Great, okay. So I'm just going to try and recap 25 minutes in 30 seconds. So here goes. So we're hearing still plenty of opportunity. Growth rate might be flattening, but that's just a natural product of the bigger you get, the harder it is to keep going at the same growth rate. Regulation is actually generally welcome, certainly by all of us here. This is becoming a big industry and we need more people, to your point, Christian. And also, you know, no return comes without risk. So we are all, I think, you know, when you're looking at investment managers, we're all very, very focused on risk. And we're devoting a lot of energy to that. And hopefully that's put us in a good place. So I've just hit 0 seconds left. So can I please ask you to put your hands together and just thank all of our panellists this afternoon.